Hello, I'm Bernard Hickey with the Daily Briefing from interest.co.nz. Today we'll look at the latest bad news from Property Finance Group. We'll update you on the moves in the 5-year fixed rate mortgage market, which seems to be the hot news zone for mortgage rates, and we'll detail the latest economic news here and abroad, where there are fresh signs of an economic slowdown. And we'll look at what that might mean for interest rates. Firstly, at home in the finance company sector, you might remember a company called Finance Securities, which was a Christchurch-based finance company run by Daryl Queen. Finance Securities is owned by Property Finance Group, which is listed on the NZX. Last year, Finance Securities was put into receivership, but it managed to get its investors and debenture holders to agree to roll over the debt and pull it out of receivership if a series of steps were taken. This included a recapitalisation by Property Finance Group of Property Securities. It seems now this recapitalisation is in trouble because the bridging financier who was going to loan Property Finance Group the necessary $710,000 has been unable to make the loan because of turmoil on credit markets. Daryl Queen hasn't returned our calls to give us more details, and neither has Kortamenta. They are the receivers for Property Finance Securities, which owes about 4,000 debenture holders about $80 million. These debenture holders met before Christmas to approve the rescue deal in the hope they would get their money back. We'll keep a close eye on this one. Now let's look at what's happening in the mortgage market here in New Zealand, where the 5-year fixed rate mortgage is in the spotlight. ANZ and national banks have cut their 5-year fixed mortgage rates to 8.95% from 9.15%, bringing their rates into line with ASB's new rate of 8.95%. And we've just heard Westpac have also just cut their rate to 8.95% too. It's only BNZ now which is a touch out of the market at 8.99%. Of the smaller banks, TSB is right out of the market at 9.15. Kiwibank continues to have the lowest rate at 8.75, having cut it from 8.85 last week. Now this 5-year fixed rate looks to have become the key battleground for banks competing for new mortgages in the newly tightened housing market. This is where home buyers are struggling to afford high interest rates, and they're simply looking for the lowest rate they can find. And right now, they're finding it out along an increasingly inverse yield curve. That's where short-term rates are higher than long-term rates. Now, it would make sense to borrow on a long-term basis if you're confident the yield curve will remain inverse for the period of the loan. And 5 years is a long time. You've got to remember, we lost the World Cup in both the semi-final and the quarter-final in that time. That's the dilemma many borrowers are facing. Do they believe the 5-year rate will stay below the variable rate or shorter fixed-term rates for 5 years? Now, economic theorists will tell you that an inverse yield curve is unusual and only happens in the early stages before an economic slowdown or recession. But have a look at this chart, which shows that for most of our economic history post-deregulation, we have had an inverse yield curve. Long-term wholesale rates have been falling further in recent weeks as investors see a slowing global economy, and longer-term government bond yields have dropped as investors flee to safety. But will it last? That's the question people taking out 5-year mortgages should ask. And finally, we wrap up with a roundup of the latest statistics showing where the economy and interest rates might be headed. And the direction seems to be downward for both. We see figures out from Business New Zealand showing growth in New Zealand's services sector has slowed in December, and consumer confidence fell in mid-January according to a survey by Roy Morgan. And overseas now for the latest in the US recession watch. In the US, new home sales fell a deeper than expected 4.7% in December to just over 600,000. This is a 12-year low and ended the worst sales year since records began in 1963. The median new house price dropped 10% in 2007. That's the biggest fall in 37 years. However, US investors are betting the US Federal Reserve will continue to bail them out with rate cuts. They expect the Fed to cut official interest rates a further 50 basis points after the central bank's rate setting committee meets on Tuesday and Wednesday. Such a cut would widen the yield gap between US and NZ rates to 5.25%. That really is the mother of all carry trades, as Mark Weldon described it this week. I'm Bernard Hickey from interest.co.nz with the Daily Briefing. Catch you tomorrow.